The U.S. Treasury yield curve in 2026 is still one of the clearest market dashboards. When short-term yields sit above long-term yields, investors are pricing in slower growth, tighter financial conditions, and a higher chance the Fed will need to cut rates later. In a normal expansion, the curve slopes upward because longer bonds demand more compensation for time and risk. But when the curve flattens or inverts, it often signals caution. Policy is restrictive, credit gets tighter, and future growth expectations cool. The big question in 2026 is whether inflation has truly cooled enough for the Fed to pivot. If disinflation continues, rate cuts may ease pressure on borrowers and help the curve steepen. If inflation reaccelerates, cuts could be delayed and the inversion may persist longer. For investors, the curve is not a timing machine, but it is a warning label. Watch Treasury spreads, unemployment trends, credit conditions, and earnings revisions together. A recession signal strengthens when inversion pairs with weakening jobs and softer spending. The practical takeaway: don't trade the curve in isolation. Use it to frame scenario planning across bonds, equities, and cash. Higher long-end yields may reward duration again if growth weakens, while a steepening curve can favor financials and cyclical sectors. Thanks for watching. The 2026 Treasury yield curve story is really about growth, inflation, and policy moving together. Stay with Market Insight Guru for clear market context, and we'll see you in the next analysis.